Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and over the last few years, we've seen this real proliferation of private market asset managers as the industry has just really gained momentum. So today, we're going to be trying to learn how you can distinguish the good, the bad, and the ugly in both deals and asset managers. And to do that, we're joined by Kelly Marty from Nuveen Churchill. Thank you so much for joining us today, Kelly. It's really awesome to feature you here in Australia and feature you on The Pitch.
Thank you so much for having me. It's a pleasure to be here.
Okay, let's go back to basics. What sets Churchill apart from the rest of the pack, both here and overseas?
Sure, absolutely. So Churchill is unique in the sense that we've been investing in the US middle market for over 18 years. And when investors are looking to invest in our funds, they have the ability to see a very long-term track record and our performance throughout various market cycles. Another thing that differentiates us is our sourcing strategy. So as we're sourcing transaction opportunities from private equity sponsors, we have consistency of deal flow, seeing transactions from private equity sponsors because we're investing in over 300 private equity funds. So that's a distinct competitive advantage for us. The other thing would be our scale. Churchill has now amassed $50 billion of committed capital. So as we're approaching these deal opportunities in the market, we have the dry powder and the ability to speak for the entire transaction, be that $300 or $400 million transactions. And sponsors like to see that scale in an asset manager that they choose to align with. They want to see scale at the onset as well as dry powder to support the businesses going forward. And we can certainly show them that.
How competitive is that deal sourcing market?
It's quite competitive. So the market has really changed. We get a lot of questions about new entrants and how are they sourcing deal flow. And to be honest, it's very difficult to source new deal flow as a new entrant into the market. And the reason why is that the deal opportunities actually come directly from the private equity sponsors. So if you don't have a long-term relationship with that sponsor or really a reason to exist in their eyes, it's going to be difficult to see their transactions. What used to happen was that a lender would be awarded the lead title in a transaction and then they would sell parts of that loan to other participants in the market. That doesn't exist anymore. The sponsor is dictating who exactly is shown the transaction and who is allocated the deal. So again, it's that very relationship-driven process with the private equity sponsors that's going to ensure your success.
I feel like that's quite surprising. I would have thought that it's more so about the price rather than those relationships at the end of the day.
You know, we differentiate between the public markets and the private markets. So the public markets, to your point, is very price-driven, and we call that transactional-driven, whereas the private markets, it's all about relationships. And again, the deal sourcing and the way to actually execute transactions is very much based on relationships, trust, long-term track record, and history.
Let's go a little bit deeper into that. What is the secret sauce in your mind to a good private equity deal?
Sure. There are really three components to it. One, of course, is the company, right? Is it a strong performer? Does it meet the investment characteristics we like to see in a business? Two is the private equity sponsor buying the business. You want to make sure that it's a private equity sponsor that you know, that you trust, that you can, again, analyze their track record and make sure you're aligning with a top-notch equity sponsor. And the third component is the structure of the transaction. I mean, you can have a great business and you can have a great sponsor, but you can structure that transaction too aggressively, and that's going to lead to trouble. So what you want to do is make sure you're structuring that transaction with a conservative lens, and importantly, aligning the lender and the sponsor. And typically what we want to see is the sponsor investing more capital in the transaction than the lender is, because that's the alignment of interests that's really going to make sure that the interests are where you want to see them down the road if you're starting to address amendments or something, down the road from a financial performance perspective.
What is the good, the bad, and the ugly of deals?
Yeah, absolutely. As far as what we like to see in the businesses that we choose to finance, market leadership. We want to see a strong reason to exist. And the reason that's important is because market leaders in a particular industry do have the ability to drive pricing decisions, right? If you're a low market share participant in industry, you're going to be a price follower versus a price leader. So market leadership is very important. Strong cash flow conversion is a key attribute that we look for in businesses, and certainly non-cyclicality. So when we see those types of attributes, we tend to get excited about the transaction and want to dive deeper into our full due diligence process. That can take several weeks. I mean, as we're assessing these businesses, we're spending 3, 4, 5 weeks analyzing the business, meeting with the management team, talking to the private equity sponsor buying the business, really understanding their investment thesis. So again, it's a very deep dive into these investment decisions. Things that we don't like to see in a borrower, the red flags, if you will. Cyclical trends. So if you're looking at a borrower opportunity that is highly cyclical, that's going to be very difficult to underwrite and hard to cash flow model that transaction. Another red flag that we would see that would turn us off with the transaction is customer concentration. So again, if you're looking at a borrower and they have one customer that they're selling to that's 25% of their revenue, for example, you run the risk of them losing that customer and having a massive impact to that business. So that's definitely a red flag for us. I would say a third red flag we look for is regulatory risk. If you're underwriting a business that in the status quo environment is fine from a regulatory perspective, there's no impact, but you have line of sight into knowing that there's some regulation coming in the foreseeable future that will impact that business, massive red flag. So again, they're very specific credit attributes that we look for and also specific red flags that'll turn us away.
How about when it comes to managers? At the beginning in the intro, I talked about there being this proliferation of, I guess, private credit, private debt managers in Australia at least. I'm not sure what's happening in the US if it's the same. What do you think it takes to distinguish the good, the bad, and the ugly from those managers themselves?
Yeah, absolutely. I'd say a couple of components first and foremost. One is their sourcing strategy. How are they seeing these transaction opportunities from the sponsors? If they have a reason to exist in the sponsor's eyes and they're seeing a lot of deal flow, they can be highly selective. If you're an asset manager that's kind of seeing the roll-off of other asset managers, the deals they're turning down, that's not a great position to be in because you're going to be saying yes to transactions that probably don't have the high credit worthiness that you expect. Another thing I would look at is track record. So for example, I mentioned Churchill. We've been investing in the US middle market for over 18 years. We have a very strong and defensible track record that our investors are able to see. If you're aligning with an asset manager that's new to the space and can't demonstrate that strong track record, that would definitely be a red flag in my opinion. And one additional thing I would note is scale. When you're looking at asset managers, it's important to know that that asset manager has significant scale because, again, the more capital they have to deploy, the more investment opportunities they're going to see and the more likely they're going to be leading those transactions, which is a great position to be in as an asset manager.
Okay, well, thank you so much for your time today. It was awesome to feature you on The Pitch.
Thank you so much for having me. I really enjoyed it.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.